Awesome. Thank you, Amy. So I'm Jillian Robison, and I'm located in our Spokane office. And then we also have Kate Stenzel, and she is with us in Mankato. So just welcome. Hello. Nice to see you guys. Let's just start with our end goal, which is having a successful year end. So this webinar is going to talk about, we always have a year end webinar too, which I think those go out via email if you want to register for that at a later date. That's going to be in November. We thought a mid-year check-in would be great to just prepare everyone for year end, so we're not as stressed out in November when that time comes. So our goal is to get our W-2s and our 1099s figured out, and that is our plan in this webinar. To start, we wanted to talk about 10 common issues we have at year end, and then we'll give you guys some solutions. So the first one we wanted to mention was missing social security numbers or federal ID numbers, as well as addresses. And that happens often when you, like in 1099 world. So just to kind of cue that up, I'll talk about 1099s and Kate will talk to payroll. So in that case, you pay somebody and then you don't have their social or their federal ID number, and then come year end, you can't get a hold of them, or the timing in January is so tight and you don't have enough time to gather all the information you need as well as prepare all your forms. So that would be from the 1099 perspective, just following up on, or the issue is not having those numbers at year end, and we'll address how to solve that in a few minutes. Kate, did you want to talk on the payroll piece of that?
Yeah, so on the payroll piece, if you have missing or incorrect social security numbers, then it will create issues with your W-2s. You'll submit them to the SSA where their employees' benefits will not be applied correctly to their benefit account, having the wrong social security number on there. If wrong addresses, the W-2 could be mailed to the incorrect persons. It could get in the hands of the wrong person for that. And then having incorrect or missing social security numbers can also lead to penalties because you're submitting an incorrect form. If you have nothing on there, so you put all zeros on for the social security number, which then could create penalties for yourself. Moving along to number 2, not receiving updated forms of W-9 and W-4s. For payroll purposes, not receiving an updated W-4 could result in under or over reporting of a withholding on each paycheck for that individual employees. And we all know how upset employees can be if they have to owe in at the end of the year, because it's always payroll's fault and not the individual's fault.
Yeah, and not getting an updated W-9 could be an issue if somebody changed their status and they don't need one, or they didn't need one and now they've changed to like a Schedule C filer and they do need a 1099, and you didn't prepare one because you didn't have an updated W-9, so you didn't get them what they needed, and that penalty would be on you. And then missing withholding and reminding requirements on a 1099 form. That kind of all goes in the same bucket of not having the right information, because either you're like, the main one I see withholding on 1099s would be a 1099-R, which is a retirement form. And if you're not aware that you need to withhold, or that you did withhold, and then you don't know how to remit, by the end of the year, that could be a real big mess. The other forms would be if you had a 1099, you got an IRS notice because you didn't have the right TIN or federal ID number. And if you didn't respond to that notice appropriately, then you need to start doing federal withholding. You might not know about those requirements and you might not do them. And then by the end of the year, again, it's a huge mess.
Number 4, missing tax payments and deposit schedules. This is where, for payroll purposes, you see where you get the largest penalties assessed to your company. You got to know your deposit schedule. Like, when are my tax payments due? Are you a semi-weekly depositor where your payments are due after every payroll? Are you a monthly depositor where they're due by the 15th of the following month? Did you pay out large bonuses where your liability goes over $100,000, where you have to make that tax payment due by the next business day? And once you become over that $100,000 rule, you turn into a semi-weekly depositor for the remaining of the year if you aren't currently at that status. Do you have anything to add for that one for 1099s?
Well, yeah, I would just say on 1099s, if you are withholding, you have to follow similar deposit schedules. So mainly I would see this one in a 1099-R situation where you're having people taking regular retirement distributions, and then there's withholding on those. But similar, like to the 941 deposit schedule, there's a 945 that's filed at the end of the year that would show the amounts and the timing of those. So yeah, you could totally miss it if you don't realize you have withholding. And by the end of the year, that could be a pretty hefty penalty. And then we're issues with states having an issue where you're supposed to withhold or pay unemployment and you don't, by the end of the year, that becomes quite a mess as well. For 1099 purposes, some states, which we'll talk about later, have certain different requirements. So you could totally miss those altogether if you don't realize you're paying an independent contractor in a different state that has different rules than your state. But payroll is a lot messier. So Kate, you take that one away.
True fact. And it always seems like if payroll is the last person to know if there's a new hire and your company goes into a new state. We're always the last to seem to know. But you know, if you went into a new state, you've been doing that withholding. Are you actually registered in that state for withholding unemployment in any localities that would, you know, in particular states that it would apply to? Just make sure that you're current on all that, so that when you come to the end of the quarter, the end of the year, you're all set and you're able to submit your quarter and annual returns successfully. Number 6 mainly applies to payroll with termed employees missing taxable fringe benefits. You know, this is a big one that most companies usually put on their taxable fringe benefits at the end of the year. But if the individual terms throughout, you know, at some other point during the year, you know, make sure you get on those taxable fringe benefits. You know, group term life insurance, or you an S corp, you have to add on S corp taxable fringe benefits. Personal use of auto. A good scenario could be that to avoid that would you know, tax them on every paycheck. Like if you do group term life insurance, you know, figure out what it is on a per month basis or on a per paycheck basis. That way, if you come to your final paycheck, you don't have to worry about remembering to add it on there because it's been on there the entire year so far. Employee versus independent contractor. This is always a big one that we see, you know, questions come up, and this one can be costly if it's not done right. And there's always that gray area that people are like, well, I could see it going either way, but it's always what it is in the IRS's eyes. You know, not paying, you know, for employees, they want to try to avoid trying to pay the employer portion of taxes, and the contractor pays both portions of it. We see that on the payroll side of it, and trying to avoid, you know, benefits and, you know, having to submit that W-2 at year end.
Right, and that's opposite for 1099s as far as you should just figure that out as you go throughout the year versus wait until the end of the year and then trying to figure out if you need to do W-2 for somebody, because it could be a lot of taxes. And generally, it would be all on you taxes because you didn't withhold any because you were paying them as an independent contractor. The other issue, or number 8, would be not knowing your due dates for both your federal and state forms. So you would not file those timely if you didn't realize you had due dates, and probably gets trickier with the state forms if you don't know you're in a state. Some of those dates aren't always the same as the federal dates. But 1099 purposes, generally January 31st is that due date to the employer, to the vendor, and then IRS is sometimes January 31st and sometimes February 28th. But states could be different. I think some states like Iowa is February 15th. So just throw a little wrench in there.
Yeah, same way with payroll. I think the states probably follow the same way as like the 1099s. But like with payroll, obviously we have quarterly returns, you know, knowing the due dates for your federal, you know, the last day of the month following the quarter. And then also the same thing with states, you know, majority of the states will follow that same rule, but there are a handful of states that, you know, like for example, Oklahoma withholding return is due by the 20th of the following month of the end of the quarter. So just really know those dates. Because you can, if you miss those dates, you can be charged the penalties for a late filing fee. And then number 9, not knowing your filing requirements for both federal and state forms. You know, what's required to be actually filed for, like for payroll purposes. You know, are you a 941 filer? Are you agriculture? You need to file a 943 return. Do you qualify to be an annual filer for it's a 944 versus a 941? And then also remembering that you have your 940 federal unemployment form if you're subject to federal unemployment that needs to be filed at year end. And then knowing your state forms as well, you know, what states have you done withholding in, and what states have you actually had for unemployment that you need to submit?
I'll let you take 10 too, Kate, since that's payroll.
Yep. And number 10 is finding and fixing a Q1 error in Q4. This is why we always say, you know, make sure you're tying out everything either on a quarterly basis, so that when you get to Q4, when everyone's swamped and we're trying to get those W-2s out, that you're not having to go through and figure out where you're off. And, you know, most times, you know, it could end up in Q1 that if you would have just tied out like year to date in Q2, you could have caught that right away. Oops. Sorry, we both clicked.
Okay, I'll do it.
Okay.
So then basically our webinar now, we're just going to talk about the solutions to these problems. And the summary is, if you know your forms, And then reconciliation, watching for state issues when they pop up versus having to scatter at the end of the year, knowing if you've got an independent contractor or an employee, using electronic data when you can, and then knowing what's coming for the upcoming year so that you don't miss something. So we'll start with forms. Go ahead, Kate.
All right, so up here we have the 2022 Form W-4, in which everyone is familiar with this. This form has stayed the same since the big change back in 2020. We still get a lot of questions on this that people are still confused of how do I fill this out? When is the form going back to the way it was? You know, I think we all wish that it would go back to the way it was, but I don't see that happening anytime soon. One thing about this form is you can't tell employees how to fill it out. They really should be, you know, consulting with their own tax accountants to help them figure out, because there's so many moving factors into this that you as the employer don't know all their stuff that goes into their individual returns. On the top of the form is where the employee puts their name, address, social security number. This is probably the most important thing as far as payroll, because this is where you're going to get the correct spelling of their names and that their social security number. The social security number should match their address. You know, if you enter in the wrong social security number into your system, the W-2 goes out with that incorrect social security number. You know, a couple of years ago, they were doing those mismatch letters that the SSA was sending out that saying, based off of what you submitted on their W-2, it doesn't match what's in our system. You know, and they weren't penalizing people at the time, but there was talk of that, you know, going forward, if they start that up again, that they will be penalizing. It was kind of a, you know, like, here's your one warning, and then, you know, they could start this back up. So you want to make sure that everything matches with what the employee has on their social security number and with what they have on their W-4 form. And this W-4 form is really what helps us calculate the paychecks correctly for withholding purposes. There is a new form that's always issued every year, so you should be using the 2022 form, you know, not using anything prior to that. And another big question we always get at the beginning of the year is, you know, do I need to have all employees fill out this form every year? And the answer to that is no, you don't have to. The only reason an employee would need to update their form is if, you know, they had any changes to it. Otherwise, they can continue to use the prior year's W-4s, or whenever they last had to update their W-4 form is still valid for payroll purposes. We'll discuss a little bit later, but, you know, each state could potentially have their own W-4 form as well. So this is the federal W-4 form for this one. All right, so with the form W-4, there are a step-by-step process for the 5 steps on the form that employees need to complete, or they can skip it if it's not doesn't apply to them. Steps 1 and 5 are required, but 2 through 4 are optional. So in step 1, that's where the employee, like we said, with employees are going to put their personal information, their name, address, social security number, and then what their filing status is. Step 2 is where the employee can account for multiple jobs. So if they work more than one job, or they're married filing jointly and their spouse works too, this is where they have 3 choices on that form, you know, to choose from. And within the W-4 instructions, there are worksheets in there for them to be able to assist with helping get that filled out. Step 3 is where they claim their dependents, your qualifying children, and then other dependents. And then step 4 is where they can make adjustments for other income and itemized deductions, this is optional, like I said before. But this is also where they can claim what they want additional withholding. You know, they want an additional $100 taken out or whatever. That's where they can claim it on there. And then step 5 is where they need to sign and date the form. And you got to remember that if the form is not signed, it's not a valid form. Another question that comes up with this new W-4 form is it's not as clear as to where, if the employee wants to claim exempt, where do they put that on the form? It's right below box 4C. They actually just have to write in the word exempt on there. There isn't a line specified just for that. So it's just kind of a blank white spot in there that they can just claim or write the word exempt on there to be able to claim exemption. And remember, if anybody does claim exempt, they do have to fill out a new W-4 form each year that they want to continue to claim exempt by February 15th of the following year. And if they do not do that, then you as the employer need to change them to be single with 0 adjustments until they would submit a new form on there. And usually once they go a paycheck or 2 with having more taxes taken out, they're pretty quick to get that form filled out. And then a polling question to pop up if you guys want to answer that. Also with this form W-4 form, there is tools to help with filling this out. The IRS has continued to update these or have them still available since when they kind of initiated this form. There is the publication 15T, the federal income tax withholding methods that employers can use for guidance on withholding. There are the webinars the IRS put together on the form back when it was new. And they also have the IRS tax withholding estimator. That is a good one still that people are using. I do refer clients to tell their employees to go out there, because it does take them step by step of answering a series of questions of what their income is, what their deductions are. And then it will, at the end, it will help show you what you should be filling out in your form based on the information that was put in. But employees do have to remember, you know, the information outputted is only as good as what is inputted on there. And then just a reminder, you know, not to have your employees, or to have tell your employees how to fill the form out, that they should be talking to their tax accountant.
Yeah, and I'll talk a little about the W-9, which is essentially the W-4 for 1099s, and it requires a name and then a business type. So you know whether or not they require 1099, and again, that social or federal ID number. And it also has a signature at the bottom, so you can have proof that it's a good and valid form. If you have a W-9 that's not signed, the IRS will likely not rule in your favor for penalties and issues because you didn't get a signed form. And we had a question pop up: how often do you recommend getting W-9s? I'll kind of address that on this slide here. So I always say request one before you make a first payment. Once you make the first payment, if you never pay them again, you don't get a W-9. It's not likely someone's going to just be handing their information over if they don't have a reason to circle back with you. Other options too would be to send an annual letter with the first payment of the year requesting an updated W-9. But once you have one, you don't necessarily have to keep requesting it. It would only be if something had changed, which you won't know if something has changed if you don't ever request another one. And you could, if you have a ton of vendors, just pick like A's, you do first quarter, B's, you do second quarter, C's, you do third quarter, and so on. And then, you know, every couple of years, you'll have basically done all of your vendors with that updated letter or that request for an updated W-9, if that would make sense for your company. Really only need it once, but it's just a good idea to follow up, especially if you know something has changed with your vendor, to ask for another one. Like if you get a check back in the mail because they moved, it's a good idea to get a new W-9. Another best practice is to use a TIN verification program, and that will just take what you got on your W-9 and verify that that agrees to what the IRS also has for this vendor. I like to use that especially if I'm dealing with companies that also are sole proprietors, so you can just verify the name matches the social, or they're using their federal ID number and that does actually match their business name, because sometimes those get a little tricky. Like the person who's doing it doesn't even necessarily put down the right information on their W-9, or if they're not legible, definitely like to run it through the TIN matching program and verify that you got the numbers right, because it's hard to read. And then if you're doing that all the time as well, you have the opportunity to quickly follow up with someone instead of waiting until January when you have this huge list of W-9s you wanted to check up on or follow up on. And then another little tidbit is you could use a corporation more often because they don't require 1099s in most cases. There's a lot of times they do. You have to review the exemptions, but for like the NEC and the miscellaneous, the two most popular forms, those generally have less instances of 1099 need. And then paying vendors with credit cards is also another way to not have to do a 1099 miscellaneous or NEC, for example, because the credit card companies will issue them in 1099K, which we'll talk a little bit about more later. I'm getting a question on TIN verification programs as well. There's a few. We use Tax 1099, and they also have like a sister company called Compliancely. Compliancely is just TIN matching, but Tax 1099 also will prepare forms and collect W-9s for you. So I think Track 1099 has a TIN verification as well. I mean, you could just Google it and reach out later if you want some advice on what you find also. Another thing we want to work on as we go would be reconciliations, and this would be bank reconciliations as well as payroll reconciliations. Identify uncleared checks. Also, if you had sent a vendor a check and you haven't actually got it back in the mail, but it didn't clear, then maybe you would want to check with them and make sure you have their appropriate W-9 data. Maybe you have the wrong address. And they'll tell you which tax payments went through the bank. So you know if something did or didn't get made, or you thought it got scheduled, but it didn't, or if your payroll system somehow didn't do something and so the tax payment didn't actually hit your bank. And then, you know, just checking it got reported to the right general ledger. And this is important for 1099s if you're close to that $600 limit for most of them. Because if you coded something to the wrong GL account, then maybe the total of the amount to the vendor would not be $600, just because it's 320 in one account and 320 in another. So quick look, that wouldn't get pulled, but it's really 640. And so it would require a 1099. So that's part of the reason why it's important. And then also just kind of watch for employee checks that are outside of payroll. And I'll let Kate talk to that a little bit.
That can be kind of a big one that I just wrote my employee needed some money, so I just wrote them a check. Well, that's if you're writing them a check, it still stuff needs to be ran through payroll. You know, it can always be grossed up or whatnot, but it does become taxable wages to that individual. We can kind of catch that stuff a lot of time at year end, especially gift cards are a good one that people just, you know, put through their AP as purchases, but then we actually need to know the individuals that receive the gift card so that we can put them on as taxable wages as well. All right, so reconciling wages and withholding. The importance of reconciling each quarter end is to identify software errors. You know, make sure you have the correct rates and the wage basis, especially, you know, before you ran that first paycheck of the year. You know, one that came up that we assisted with, the Social Security limit for a client was not put in correctly. The wage base, you know, it is 147,000 for 2022. Well, whoever had updated it only put it in as 14,700. So after a few paychecks, employees stopped paying into Social Security, as well as the employer matching that portion, because that wage base was set up incorrectly. And so it's kind of caused a mess that the client has had to go back and, you know, fix and, you know, catch up on the withholding and amend returns from first quarter because everything was not submitted correctly. You know, identifying incorrect setup of employees. You know, do you have your pre-tax versus after-tax deductions set up correctly? Because pre-tax will reduce taxable wages, and then that will affect the taxes that are calculated off of that. And make sure you have W-4 information updated correctly, Social Security numbers, you know, that are correct, names that are spelled correctly. If an error happened in a previous quarter, you know, how are we going to go back and fix that? If you have to amend returns, you know, that's kind of like what we talked about, going back and fixing an error for first quarter when it's actually fourth quarter. You know, how to avoid that. You know, if you had to avoid a payroll check in your system that your year-to-date's off, you know, if you can tie these wages out every quarter, you know, you could have an overpayment in taxes as well. And then finally, tax payments made timely, accurately, and applied to the correct quarter. This kind of seems to be a big one, especially when you're coming to the end of a quarter. And when is my tax payment, you know, what is my tax payment based off of? It's always based off of the check date, not the pay period that you're covering. So coming into July, say you're paying a July 1st check date, but it's covering for June hours, it's going to fall into third quarter, and it's not second quarter tax payments, even though it's based off of the check date, not the pay period. And that that you calculate it correctly, and that it's made timely based off your deposit schedule. All right, so then moving into knowing your state rules. On the payroll side of it, this is where we kind of come into what do we need to actually have all done for state withholding. There are 7 states that have no income tax: Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, Wyoming. So I always joke with some of my clients that are multi-state, you know, if you're going to hire anybody, go into these states, because it's A, less registrations that I have to help with, and B, then it's less, you know, returns that need to be filed at the end of the quarter. But the basic rule for withholding is withhold income tax for the state in which services are performed is kind of our starting guideline for that.
Hey, Kate, can I ask you a quick question? Somebody had a reconciliation question. I just wasn't fast enough. Tax calculations, reconciliations, do they need to be done when full payroll is being outsourced to a third-party vendor? What are your thoughts on that for those people that outsource their payroll?
It wouldn't be a bad habit to get into, because you as the employer are ultimately responsible for everything, even though you outsource the payroll as well. So it wouldn't be a bad thing to do once you get your reports back, just to reconcile with what you've had taken place throughout the quarter.
Sounds good. Thanks so much. Go ahead.
Yep. Yeah, so just continuing on with this, the withholding rules for multi-state employees. So you have employees living in one state, but maybe working in another state. There's kind of 3 rules to help determine which state actually do withholding. And some of these can get a little complicated, but we're going to just kind of start with the basic rules. So rule number 1 is the resident is defined. So being domiciled in a state or spending more than a certain number of days in the state will help determine the withholding on that. And domicile is the place where an individual has a true fixed permanent home and establishment. And some of the examples there are property ownership, bank accounts, driver's license, and vehicle registration, voting registration, presence of family, and their membership. They have membership to clubs and churches. We start with the state of residency. The rules for residents performing in another state or non-residents who perform within your state. And it's also based off of if you have nexus. So some kind of business connection for both of those. The next rule has to do with reciprocity. Reciprocity agreements, withheld where the state of residency, not where the work is performed. This is the basic rule, is just a starting point. And if your states have reciprocity, your employee submits a certificate of non-residence for that state that they're working in so that their home state can be the withholding on there. So example of this would be, let's say you have an employee that lives in Kentucky, but that same employee not only works in Kentucky, but they work in Illinois and Indiana. The employee would submit a certificate of non-residence for Illinois and Indiana, and the employer would only need to withhold Kentucky withholding on the wages earned. Doesn't matter which state the wages are earned, because those 3 states have reciprocity agreements with each other. So if you're going into a new state, I'd really suggest looking at, where those states have reciprocity with, to see if you can avoid having to register into a new state with that. And then the third rule is resident versus non-resident. If an employee is a resident of one state and performs services in a state where there's no reciprocity agreement, you must consider the laws of both states. So this is where it gets a little bit more complicated. The state in which services are performed will almost always require withholding, but know that this rule could make your employees subject to double taxation. So a fun one that I always like to use as an example is if you have an employee that, is working in New York, the minute you step foot in that state, that New York wants your money and they want you to do withholding. And so you got to look at all the state rules, like, and also, for example, like New York, it doesn't matter the amount of wages you earn in there. If I earn $1,000 and I earn $100,000 in Minnesota, my New York wages have to be my full wages earned for the entire year between Minnesota and New York. So my box 1 wages need to match my box or my New York wages too, which seems, severely unfair, but that's just the rules that are set up for that individual state. There is the mobile workforce law that they've been trying to get passed, as a bill for many, many years, that would allow 30 days into any state before taxation is required on non-resident wages, which for anybody in payroll, that would be just awesome if they would pass that. It'd make life a little bit easier for that. So now that we've gone over withholding, then we have to look at unemployment rules for multi-state payrolls. There are 4 factors to determine which state to allocate funds for unemployment, because you want to remember, if you could have withholding for an individual on multiple states, but you only want to report unemployment to one state. You don't want to report state unemployment to all the states that you did withholding for. So there's the 4 steps that we need to look at to help determine which state for the multi-states to use. The first one is, are services localized? For outside states that are incidental compared to services performed in state, if that would apply. If you have no localization, then it's going to be based off of, do you have an employee have a base of operation in one of the states? So example, if your employee reports to work in that state, they have an office in that state, or they receive instructions from the employer from that particular state. If you would have no localization, no base of operations, then we look for the place that the employee would receive directions or control for the services. And if neither 3 of those would apply, then we look at what state is the employee a resident of, and that's where you would report the unemployment to. The state unemployment wage transfer, if an employee's unemployment taxable wages for one state may be applied towards the SUI wages base of another state within the same tax year, as long as the employee is working for the same employer. Except for Louisiana, Minnesota, and Montana, they do not allow this. So there's always going to be exceptions to the rules on this. So as we talked about the federal W-4 form earlier, which is the employee withholding allowance certificate, there are 7 states that accept the federal form W-4, and they're Colorado, Delaware, Nebraska, New Mexico, North Dakota, South Carolina, and Utah. All the other states, if they have state income tax, remember there's the 7 states that don't have it, they have their own state W-4 form that you need to have the employees fill out. So example, I'm in Minnesota, I fill out my federal W-4 form, but then I also have to fill out my Minnesota state W-4 form because Minnesota did not configure to the federal form. And so Minnesota is still based off of the number of allowances. And just a reminder, if you're multi-state, you can't base the withholding off of what the state listed on the W-4 form that the individual may fill out, because they may be technically working in a different state. You know, example of that, like if you have college students working for you, they may be living out their home resident, maybe, you know, like say example, Wisconsin, but they're coming into Minnesota work. They put down their home address, their parents' home address. That doesn't mean you do Wisconsin withholding. You have to look at see where the work is performed and kind of looking at all the other rules that we kind of talked about. So just be careful on that, that just because the W-4 says one state doesn't necessarily mean that that's the withholding that will actually take place on there. You know, where is your employee working? This has always been a question that payroll, you know, us as advisors have gotten, but it's really been a hot topic since COVID has taken place, because you see a lot of people that they can do their job wherever they have access to the internet and a computer, they're able to do their job. And so the thing you really have to look for is, you know, where is the employee working and living? You know, more employers are hiring all over the country since, like I said, people can, you know, live and work wherever they want. So you got to remember the basic rule that we kind of talked about in the beginning, you know, where are they living and working? And that should be the state that you do the withholding in. And then also the unemployment you'd have to look at as well, because they're physically living in that state. So the unemployment would need to apply to that state as well. All right, I'll turn it over to you, Jillian.
Sounds good. So similar rules for 1099s. You have to figure out if your state participates in a combined federal state filing program. So when you file the 1099, some of them directly, the ones listed here, I'm not going to say them all, directly just flow that information through to the states. Some of them may still have to directly file though, and that would be usually if there's withholding or something, sometimes they have an additional filing versus just the combined federal state. And so you just have to pay attention to that. And then there are these few states here listed on the second bullet that definitely do not accept a combined federal state, at least at this point. So you do need to be ready to separately file those. And some states don't have income tax, and so they don't require 1099s at all. And those are the 7 listed there. But yeah, just paying attention to where you're paying and where the work is being done is important for 1099s. Similar rules to the payroll, but just a little different. And then we'll jump into the employee versus independent contractor rules. The basics from the IRS website are there's 3 quick items to determine if they're behavioral control, financial control, and the type of relationship. So behavioral is essentially, do I have the right to control the person working for me, or do they kind of set their schedule and rules? So like I'm a 9-to-5 type worker, or do I have someone that comes in and does the floor and their job is to get the floor done when they can? So do I control them? Do I say they have to be here at 9 every day and stay until 5 to work on that floor financially? You know, are the financial things controlled by the payer, for example? Do I tell them when they get paid, like, here's your salary for getting this floor done? Or is it more like, you tell me what I'm going to pay you based on what you say the work is worth? And then whether expenses are being reimbursed or who provides the tools. If I were in an office and I have someone come in and do the floor, it's likely they're bringing their own tools and supplies. I'm not providing them anything to do that job. And then for type of relationship, are there written contracts or employee benefits that this person is getting? So that person coming in to do my floor is likely not going to be having vacation pay. They're likely doing their work, and when the floor is complete, they're leaving. And then will the relationship continue after the job is done? So if I'm a 9-to-5 employee, I'm likely working there all the time, and my work is likely key to the business. So like in our case with accounting, I do accounting and I'm a salaried person and I do have vacation, pension, or retirement insurance type benefits. That's definitely more employee relationship versus the person that did the floor. Once they're done with the floor, they're pretty much done. So the relationship won't continue. And that flooring is not key to our business. So likely not an employee. And that's just kind of a summary. There's lots of other details you can go into on each of these, but whatever you decide, it's just important to make some sort of memo and have an agreement on why you chose what you chose. Because that way, at least you're not negligent. You're more like you studied it and figured it out and determined what it was. And then later, if somebody else is working instead of you, the person who set that relationship up, like maybe they don't know the reasons you did that. And it would be nice for the IRS to understand. Or whoever comes to audit you, could be a state as well. All right, Kate, take it away.
Sure. So if you misclassify some of them, these can be very costly. You know, a lot of people think that making everyone a contractor will just be easy for everyone involved, which is not the case. Maybe it will be for the time being, but like we all know that it only takes one person to be disgruntled and turn it in and say, I should have been an employee. Why am I not getting all the employee benefits that Jillian had talked about? And that's when things can really become costly for you as the employer. Could be liable for all employment taxes not withheld, as well as the company taxes. So like your Social Security and Medicare, where the employee and employer both contributed it. With an independent contractor, the employees paying both portions of those taxes. So that can become, you know, costly to you trying to, you would have to make up paying both portions of that. Could be also liable for state taxes as well. You could receive penalties for late filing of forms that will need to be filed or corrected. So if you have to go back, if you get audited and you have to go back, you'll have to go back and amend returns, which then, you know, could result in late filing of the forms and or, you know, tax payments that are made late. The employee will have to amend previous tax returns as well. So if they should have received a W-2 versus a 1099, they will have to go back and amend their individual tax return, which no one likes to do as well.
And then we wanted to talk a little bit about electronic data. I'll let Kate go first here.
Sure. So we kind of just put together some payroll best practices that you can try and implement now if you haven't been doing. Like we talked about being multi-state, if you're going into a new state, especially if you're hiring remote workers, you know, withholding and unemployment registrations can be done. Majority of the states can be done online, and it's really quick and slick to do. And usually once you submit that, you get your tax ID number for both withholding and unemployment, and you usually have immediate access to online reporting then. So you're not having to do paper returns at the end of the quarter. You can actually submit all your wage information online and get your confirmations and submit any kind of payments directly online. With the federal, if you're able to find a system, you know, if you use QuickBooks or like Jillian uses Tax 99 for 1099s, we also use Tax 99 to file our 941 series and our W-2s. Being able to file those federal returns instant or electronically will give you an instant alert when the returns have been accepted by the IRS. So you're not having to print off a paper return at the end of the quarter, mailing it in through the mail, hoping that the IRS gets it and or hoping that the IRS doesn't misplace it. Because we all know how well the mail system is and how backed up the IRS is, that, you know, your 941 return may get in a pile and we may never see it again. So being able to electronically file them is, you know, a great thing that you get that automatic acceptance right away. Or if it gets rejected, it usually tells you why it's been rejected, so you can go back and fix it right away, so to eliminate IRS notices down the road. If your payroll software offers an employee self-service online access, this is a great thing as well, because your employees are able to update the W-4 information. They can update their address if you move. Because how many times at the end of the year when we issue W-2s, do our employees say, I didn't get my W-2. Well, I moved 6 months ago. I'm sorry I didn't, you know, inform you of that. Well, that's nice to know because your W-2 went to your old address. They're able to update direct deposit information instantly. They can verify their Social Security numbers. You know, if you send out a message saying, hey, we're coming up to year end, if you can verify your Social Security numbers. And, you know, 9 times out of 10, a lot of times we have to do W-2Cs if the Social Security number is wrong. It's been wrong for like 4 or 5 years. Then we have to go back and amend all those W-2s, and not to mention amend unemployment returns as well, because when you submit unemployment wages, you also submit Social Security number information. So then you're having to go back and fix every quarter for unemployment with the incorrect Social Security number. So if they are able to access that and verify it, that's always a good thing, and update as needed. And then also with the employee self-services, you're usually able to access W-2s online as well. So if the employee would misplaced the one that was mailed to them or given to you guys, given to them by you, then they're able to reprint a copy of it online and they don't have to come bother you on April 14th, you know, like most people do when they have misplaced it and need to get their taxes filed on time with that.
I would say same with pay stubs, right? It seems like everybody's always trying to buy a house in this super inconvenient time of year and they always want their pay stubs. And so generally those are
Yes.
part of the employee self-service.
Yes, yep, that as well. Good point.
As far as 1099s, it's really nice for, like I said earlier, the ability to read a W-9, because sometimes those can be real sloppy. So if you get it electronically requested, then you at least know for sure that it's legible because it's electronic. And another good thing about having W-9s electronically is you can sort them and store them in your software, and then you can just run reports occasionally and see which, you know, vendors have missing 1099s or the addresses look funny or whatever. You know, you can just make it a process. Maybe once a quarter, you just review your list and see what's missing. And then by the end of the year, you have all of your information. And then if you also have a software program that will allow you to request them electronically, which is similar to that employee self-service where they can go in and add their own W-9, and there's not something maybe that's signed like with a hand signature, but usually those have the DocuSign abilities. So that's the same to the IRS as a signature on these forms. And then accessing it through a TIN matching program. So a lot of times you can put it into your software or someone can directly put their information into your software and then you can TIN match it at the same time and just kind of have the streamlined process of getting the W-9 electronically and then TIN matching. And then by the end of the year, you're all set and ready to go. And you're not stressing out about finding your information. And then the last piece would be to file your forms electronically. Similar to what Kate said with automatically filing those 941s, when you file the 1099s, it's not as automatic, but you still get a verification that what was accepted and what wasn't. And then you know for sure it was accepted. Putting them through the mail is just a mess nowadays and always kind of has been, as far as getting them to the people and getting them to the IRS. With the due dates on the NECs being January 31st, I would just prefer not to mail in the month of January at all, because who knows what we'll get where and when. We wanted to quickly touch on what's new for 22 also while we're here. Go ahead, Kate.
Yeah, so for W-2 forms, they are due to the employees just like they have in other years by January 31st, so 2023. They're also due to the SSA on by January 31st. There are e-filing requirements for both federal and state. There was kind of talk of for W-2s going to the SSA, dropping that number from 250 to 100 that they'd have to be e-filed, but the W-2 instructions for 2022 have been released and they still state that if you have at 250 or more forms that need to be e-filed. So I don't think that'll be changing this year, but we'll kind of have to stay tuned for years to come. Each state can vary on what they require for W-2 reporting. So just really look at that and what their due dates are. Some states want copies of their W-2s, some don't. Some have an annual return that needs to be filed with the W-2s. And then look at to see if, if the states, if you can mail those in or if they have a certain number threshold that anything above that needs to be e-filed with that. And then also penalties are increasing for 2022 filings. You can be assessed up to $290 per form for late filings of the W-2s. So just kind of keep that in mind so you can keep the due dates in the back of your mind. And then we just want to throw this slide out there. The IRS released, I don't know, probably a week or two ago that they are increasing the mileage reimbursements as of July 1st for 2022. So the standard mileage rate for business travel will increase to 62.5 cents. And then for deductible medical or moving expenses will be at 22 cents per mile. And just know that you can pay below that and it's fine, but and you can also, if you want to do a benefit to your employees, you can pay at a higher than 62.5 cents, but anything over that IRS set rate is then taxable wages to an employee.
All right, so the only new thing that I know of for 2022, but good point on the 250 number. That's still the same for 1099s. They have talked about dropping that to 100 as well. And that would be, as far as I know, the type of 1099. So if you file 100 1099 miscellaneouses, The 1096, that number has to be above 250 to have to be required electronically. So as far as I know, that's still 250, although rumors are it would go down to 100 and then maybe like 10 or something insane. But also something to keep in mind, states could be different. Some states, I think North Dakota requires it at like 10 now, has to be electronic if you're over 10 or so. Some of them are quite small, and just keep an eye on that if you have to file those directly. But the new thing for 2022 is that the 1099K, which is the third-party payments transaction form, this basically, if you paid someone via credit card, the credit card company would prepare this form and send it directly to the person that got the money, not you, which is nice. As I mentioned before, you know, you won't have to file a form if you pay with a credit card, and this is the reason. But they dropped the amount from 20,000 and 200 transactions, and that was an and, it was not an or, down to $600. So pretty much almost anybody that's using a credit card for something, I would think would be pretty much on the list to get a 1099K. And this is less for the preparers because it's more for if you're going to receive a 1099K, just to be aware of it. And the IRS will match this. So if you have other miscellaneous or NECs you're receiving, you probably want to do a reconciliation at the end of the year and make sure that all your 1099s are less than what you're reporting on your tax returns. I have seen matching notices for these. They were a little weak when this form first came out, but more and more I see them all the time. And so I sold like 5 things on eBay this year just because I wanted to get them out. And that after I hit like $100, I think they sent an updated W-9 thing because I wanted my social. I don't think I hit the 600, but it's just something to think about if you had sold anything like that or done anything through one of those people with a PayPal or eBay or Venmo or any of those, you might get a 1099, just to be aware of it, because you're going to want to collect your expenses likely and write those off. But these forms will also include anything that was on the credit card. So I see restaurants sometimes that have issues because they report their full income, but their income on the 1099K includes tips and sales tax. Things aren't necessarily income items to them, but they still are reported on this form. So usually what we have them do is report their income at a higher level and then take the sales tax and the tips as deductions, which doesn't always make sense in your head, but otherwise you might get a matching notice. I think that's our last slide. We will open it up for any additional questions. We had a few that we've answered. So if you have any other questions, feel free to reach out. I'm going to do the next slide that shows our contact info. So here's Kate and my information if you guys want to reach out, if you have any additional questions, and we will follow up with the Q&A that were submitted that we didn't get answers to. And when you guys download the slides, you should see these additional, our webinars coming up. So looks like Amy just put the slides back in. Go ahead, Amy, I'll let you take it away.
Thank you so much, Kate and Jillian, for presenting today. And thank you everyone for attending. We do appreciate it. You will get a follow-up email from us in a few days with the recording link and the handout and some fun resources for you. So watch for that to come. And we hope that you guys will join us next time. So have some time back in your day and enjoy the rest of the day. We'll see you soon.